Franchise Secrets, Erik Von Horn.
Hey, in this episode of Franchise Secrets, I have Greg Smith on, who mentored one of my good friends, Cosm, who had a very popular episode on Franchise Secrets. He just came out with a new book called No Locked Doors, Master the Keys to Turn Problems into Possibilities. Now, Greg has tremendous depth of experience in a lot of different areas in business. So we got into things about the different economic cycles. He's been through 8 or 9 of them. We talked specifically about the subprime crisis, talked about knowing your local market and the macro economy. We got into leverage, risk-adjusted returns, buy and sell side due diligence, whether you are in wealth accumulation or wealth preservation, how to go deeper into business, whether you're doing it vertically or horizontally. We got into all kinds of things that I think are going to be relevant to franchisees, franchisors, and franchise buyers. I love to talk about talent recruitment. Anytime I get somebody on that has recruited C-suite individuals, mid-level management into large companies, I always like to get their take on that. And one of the takeaways is using third-party evaluators to help you with some of the final big decisions that you're making, whether it's employees, buying or selling businesses. So this will be a fun one with Greg Smith. Greg, welcome to the show. I've been excited about having you on since I first met you on a private call with a mutual friend. So welcome to the show.
Thanks, Erik. Happy to be here.
So why don't we can go so many different places. You got such an interesting background from mentoring a good friend of mine. Interesting story there. You just wrote a book, you've bought and sold businesses, raised a lot of capital, ran some large organizations. You have some things that you probably can't talk about because you've just been a part of such interesting stuff that may not be ready to be talked about today. But why don't you give the audience a bit of your background?
Sure, I'll be happy to do that. I started my career out of college as a commercial loan officer for a national banking company. But I really didn't see too much future in it because the odds of becoming a bank president were very, very, very small. So I decided to get some additional credentials behind my name and became a CPA for just 2 years. Being a CPA at the entry level is pure drudgery. And once I got into it, I was just there for the certificate. And I have a chapter in my book about perseverance and what that was all about. At 2 years, I got out, interviewed with 3 different ultra high net worth private families, chose one, and I worked for that family and got probably 30 years of work done in the next 20. For that family and others, I've bought and sold many different businesses. I've ended up running them, commercial banks, airlines, chemical companies, deals in real estate, insurance. Presently, I'm an investment banker.
So talk about that family office or a ultra high net worth family. Like what would an ultra high net worth family, what kind of range of net worth would that be and how is that kind of calculated?
I don't think there's any real definition between high net worth and ultra high net worth. I would peg it at about $200 to $250 million in net worth. It's ultra high net worth.
And then with that net worth, is that how much is typically liquid in a higher net worth family like that?
It depends on the age and the stage of the family. If they're later in life, it may be more about wealth perseverance. So there could be liquidity in stocks, bonds, other types of liquid assets. If they're in early stage, probably highly leveraged, not a lot of cash. Cash is being redeployed in businesses for growth and expansion.
So how does that relate to the average entrepreneur? So, people take bigger risk, higher leverage early on, and then you're in wealth preservation at a certain point. So how would you translate what the ultra high net worth families do versus a normal higher net worth individual or family?
It's probably a question of scale. So the more established ultra high net worth family probably has considerably more resources, oftentimes at a holding company environment with accountants, lawyers, M&A specialists. A high net worth family may not have those resources. They may belong to a family office or an office of family offices, where they can share services and families get together and share those services on a shared basis. Deal flow probably is a factor as well. I think that ultra high net worth families have unlimited deal flow. High net worth individuals are maybe trying to find the deal flow. So they're all looking for it as opposed to deal flow coming into them on a rapid basis.
That's interesting. I run a mastermind called Tribe of Investors, and we get typically the same type of deal flow that the high net worth families get or family offices get. Because you just said like deal flow is not a problem for them because deals are always coming to them versus high net worth individuals. We have high net worth individuals within our mastermind, but our deal flow because of the mastermind and some of the individuals in the mastermind are connected to the family offices. So that's an interesting point. I also want to point out when it comes to franchising, I wanted to dive into family offices or high net worth families because some of these families own franchisors. Some of them might be franchisees, but there's a number of them that own franchisors, and they kind of have a different. Some of them that I'm thinking about right now are in that wealth preservation mode, and they are not getting into a franchise to flip it. They're getting into the franchisor for longevity, and so that's very relevant to certain franchisees that are part of ownership groups like these family offices have, or probably not even family office, but high net worth families. And I'm talking probably $1 billion plus net worth for those that are on the franchisor side of things.
Yeah.
So before we started recording, you were telling me, we're like, hey, what do we want to talk about today? And we could go so many different places. And then you're like, hey, I had this interesting phone call and this deal that came across your desk. So why don't you bring that up? I think that'd be a really interesting conversation that's very pertinent to franchisees and franchisors.
Sure. Let's do it. I just thought it was interesting because here we are in a digital world and we're always getting pounded with digital messages. In this case, an entrepreneur whom I've sold businesses for in the past, he's built 8 different businesses, referred me to a friend of his. His friend is an ad agency. His friend owns an ad agency. So he said that the ad agency wants to sell. And would you take a call with the owner of the ad agency and explore this? I did. And surprisingly, I found that the ad agency had one customer. And as a franchisor organization with nearly 5,000 sales points throughout North America. I can't tell you who it is because I'm under an NDA. But I thought it was interesting that the ad agency had only one client, the franchisor organization. And he collects most of his fees from the franchisor, but he collects some fees from the franchisees. And what I learned is the organization, the franchisor organization, spend for ads is almost entirely paper coupons. Mm-hmm. When a customer comes into a sales point, they're asked for their name, their email address, their residence. In almost every instance, they get that information. The franchise point gets that information, and it goes straight to the ad agency. And they have a highly disciplined approach in terms of how they put the coupons out, either to people that have never been to the sales point or have been once but never came back, or maybe they've come back once or twice. But once a customer becomes regular routine to the point, no more coupons because now they're loyal. So it's only to incent the initial customers to come into the point, and it's almost entirely coupons. I just thought that was very interesting.
What do you see as you out there looking at the digital world and that things are always advancing there with artificial intelligence and things like that? And then you go back to the dark ages with like print coupons. Like where do you see the old becoming new again, just in general?
Yeah, I don't know how to call it. I mean, AI is in places we don't even know where it is right now. And I think a lot of people are capitalizing on it. I think people are fearful of it. I think there's just too many unknowns to know, but I think we'll be surprised along the way. I think some of these old sales strategies may be coming back. I just talked to an organization that works in the nonprofit space, for example. They provide services to nonprofit organizations all over North America. $38 million in sales, $3 million minus EBITDA, earnings before interest, taxes, and depreciation. So there's no cash flow at $38 million in revenue. They provide services to nonprofits. The staff is 250 people, and 200 of the 250 people are high-touch salespeople, old school. They reach out to the nonprofits in the inner cities and the big cities all over the United States, Canada, a little bit into Mexico, and it's all done with personal representation. But once they get to 40, 42, 43 million, they'll have a $4 or $5 million EBITDA, and they'll be making a lot of money. But it's old school sales technique. In the
we
trenches.
have some interesting people coming into the podcast that are really they're pretty big players in the whole sales world, and a lot of it's old school. So that's going to be fun. Let's talk about some macroeconomy stuff. Like, you were in the banking world, probably still are in different ways, and you've seen things come and go. And we've just had this, shake up in the banks. It wasn't a bailout, but what can you talk about, like your history in banking, what you saw, and just kind of what you learned?
I have lived through probably 8 or 9 economic cycles. And one of the most scary cycles was in 1980, 1981, when interest rates grew to 21.5%. Imagine financing a business at 21.5%, or imagine being a bank and collecting interest at 21.5% from people that are trying to run a business and pay that kind of money. At that time, I was running a bank holding company for a private family, and we had quite a few banks in agriculture. So these were in smaller, mid-sized, Midwestern towns. In 1981, you may not know this, Eric, but bank presidents after church would go to their customers at their farms and be met with shotguns.
No way.
To collect the payment or to collect a loan, or maybe even to stop and say hello. There was tremendous friction in agriculture and banking, and several bank presidents were killed in the Midwest by their clients whose stress just manifested itself in the worst way.
Wow.
And these were disasters. The organization I was managing at the time took the initiative to meet with bank regulators locally, regionally, and nationally, and ask the examiners to stand back and give us a chance to work with the clients, work with the customers, and work through the problems. We had a plan for every customer, and it was inevitable that rates would come back down again. They weren't going to stay at 21, 22, 23%. It was just impossible for that to happen. So we had not a great deal of capital, but we had substantial capital in the banks, and we were able to compel the regulators to leave us alone. Meanwhile, they were closing banks left and right, and mostly agricultural banks. Well, it turned out that interest rates subsided. All of our customers survived. We didn't have hardly any losses. There were a few farm auctions, not much to speak of, and everything worked out just fine. I'll give you a roll forward then to 2008. Subprime Alt-A mortgages. People were able to borrow money at 95, 96, 98% of the value of a house on stated income. Stated income. And the government knew about it. There was no secret. This was encouraged. And banks that were getting involved in Alt-A subprime lending were praised. In all the business magazines, the Wall Street Journal, they were praised as highly diversified banks and banks that we should model ourselves after. And if you go back and look at how many banks were brought into failure because of that, it was a substantial number. IndyMac was the first, and you might recall lines of thousands of people in distress trying to get the money out of their banks because the banks were closed and they were shuttered. It probably didn't have to happen if we had just realized how many stated income loans were in trouble and just dealt normally through the foreclosure process. We probably could have avoided a lot of bank crises and a lot of bank problems. But the problem was initiated with bondholders who bought bonds, Lehman, Nomura, Morgan, Goldman, who thought the bond that they bought was collateralized by probably 2x value in the form of mortgage collateral. And when those mortgage values started to trip, the bond holders started to get spooked. And the government came in, realized that bondholders were going to lose money. Well, there was no guarantee that they were ever going to get their bonds back. They weren't guaranteed. They were collateralized by mortgages. collateralized mortgage-backed originated bonds. So there too, the government stepped in and it resulted in bank failures all across the country. But the percentage of loans that were really geared to alt-A subprime problems is really a very, very small single-digit percentage. So there's a tremendous crisis that, in my view, probably didn't need to happen. We go through these economic cycles all the time.
So when I think about that, you got into some of the technical things that happened and why it happened. And some of the listeners may be thinking, well, that's too technical, and that's in the past. It has, that's been there, and it didn't impact me. But that's what caused the subprime crisis with all the banks, is what caused the houses to the housing crisis, right? I mean, and values went down, and so many things that impacted the franchise community. I mean, in some bad ways and some good ways. We, at the end of the subprime crisis, the commercial real estate was going down, and that's when we got into some great lease deals because of that. But I think as franchisees and franchisors, we have to be paying attention to the macro economy. And sometimes I feel like you need a crystal ball to really understand what's happening, but you look at historical, cycles, and you can learn from them, and they're probably not going to happen the same way that they happened in the past. But I think it's important, whether you are an investor, so we deal with investors at the Tribe of Investors, or you are a business owner, or franchisee, franchisor, if you are not paying attention to the macroeconomic cycles, you might be getting caught by surprise. So what are some of the learnings from that? I mean, you were deep into that subprime crisis. Like you know a lot about that. What else can you tell us?
Well, what else can I tell you? I would say that what you just said is a mouthful, and it's probably worth repeating: to be aware, to be informed, also to be a good listener. I find a lot of people are horrible listeners when they're being told about pending crises and pending issues and pending problems. And so I think people need to be very attuned to listening, and they also need to be very attuned to their local market. We had clients in North Dakota when oil was approaching $100 a barrel. And we were able to raise capital for and sell multifamily property at some unbelievable cap rates and prices per unit. Oil crashed from $90 a barrel down to $30 and $35 a barrel. And the local market there was completely devastated. We had raised capital through Prudential Insurance Company financing $29 million on a $40 million property. Equity came in with 11, non-recourse. And 18 months later, the property appraised for $13 million. Ooh. Imagine if you had recourse.
So explain the difference between recourse and non-recourse for the listeners that may not know.
Yeah, we can do that. And we can talk about all kinds of borrowing and leverage terms as well. So for folks that are financing business, particularly if it's their first or second business, typically the bank is looking for a guarantee. The business may be the borrower, but the borrower is owned by an individual, and the bank will often ask the individual to guarantee the loan. So that's a recourse liability of the owner. It can get more aggressive than that, where they may ask another party to bring a guarantee who's unrelated to the transaction. And if the borrower is desperate for the cash, they may pay a third-party guarantor to put up a guarantee and even sometimes assets. So then we have a third-party pledge of assets unrelated to the original loan. It just piles on and on and on until the bank gets comfortable with the collateral in the event the business is not able to make the payments to repay the loan. If the owner is more established, he should be seeking to try and borrow without recourse, because a balance sheet submitted to a bank with recourse is a lot weaker than a balance sheet that has no recourse. And sometimes recourse liabilities can be substantial, and a lot of people don't understand that that's just as viewed just as well as having a debt. If a bank's looking at a balance sheet with recourse liability, they'll presume that the liability will be called upon. So people need to pay attention to giving their personal guarantee on recourse and try and get away from that.
Talk about the risk associated with that. Like, did you have some different options to have? I'm sure you had different options: recourse, non-recourse on that property. That was 40. I think you said 40 million. That dropped to 13 million, and there was probably a risk assessment that was done at the time to do either recourse or non-recourse because the terms are going to be different. So, talk about that. Either that specific deal, or maybe just in terms of risk-adjusted returns.
That all comes together in terms of the advance. So at the end of the day, this borrower who put up, I think it was 11 or $12 million of equity for the $40 million transaction, could have obtained more debt. So instead of a $28 million loan from a national insurance company, they could have obtained a $32 or $33 million loan and put up less equity from a commercial bank, but they would have had to personally guarantee the loan. They didn't want to do that. So they brought more equity, borrowed less, and got a loan without recourse. And so when the market turned, which was unfortunate, yes, they lost their equity, but they were able to escape having to repay on the guarantee of the loan. There was no guarantee.
How does that always, at what stage of the economic cycle was that? Was that they were experiencing really good times and knowing that winter's probably coming, or is that always kind of the stage of that family that is more in wealth preservation mode, going to take a deal like that?
I think everyone knew that $100 barrel oil was high risk. And this investor who made this investment in North Dakota came out of California. We were able to sell them a property that was throwing off a 10 or 12% return because the rental rates were so high. And they were highly attracted to that because in California, it's very, very difficult to make profit in that range on rental property. If you're buying it at today's prices, if you've owned it for 30 years, not a problem. But if you're buying at today's prices and you have cash to invest and cash to lay off, it's difficult to get that kind of a return. These folks that came into North Dakota from California were very astute and very seasoned investors. And there was no way they were going to borrow money with recourse or personal liability to have to pay it back. And they were able to ride a good deal for as long as the 10% return was there. But when oil crashed and the apartment buildings were 60% vacant, the value was not there. And so it's being an informed investor and doing your due diligence up front and knowing where you are in the economic cycle that can make or break a deal.
Attention, franchisors and franchisees. There are two really important resources that I want to share with you that will help you avoid costly mistakes and increase your enterprise value. The first is our free Facebook group. It's a community that has over 4,000 franchisees and franchisors in it. When somebody asks a question, they get honest and authentic answers from multiple perspectives. You can join the group for free over at franchisesecrets.com/Facebook. The second resource I want to share with you is if you're a franchisee and you want to be around a community of successful Zs and other brands and in other industries, this is why I created the Franchisee Mastermind. If you want access to the best single and multi-unit owners to know what they're doing, or if you want to be around other multi-brand owners, then you'll want to check out my Franchisee Mastermind. The reason why people join is they want access to my Rolodex, my connections, to each other. They want a shortcut success, both short-term and long-term. Links will be in the show notes or at scalablefranchise.com. So in the Tribe of Investors, we've been talking a lot more about due diligence, helping our members with understanding due diligence, how to do their own due diligence. And a lot of it comes back to, understanding the macroeconomy, learning about that and kind of where we are in these different cycles. So what can you tell us about whether it's from an investing standpoint, investing money in passive deals or active businesses on a due diligence? What are some of the things that you've learned over the years? being an investment banker and being in so many different deals on the buy side and the sell side?
Yeah, as investment bankers and licensed registered reps, we have to know as much about the buy side and the sell side as both the seller and the buyer, because we're right in the middle of it. And if it's a technical subject, you may have to bring in specialists, depending on the nature of the subject. We had a buyer once who acquired a chemical company. It turned soybean oil into a plasticizer. The plasticizer turns into saran wrap. It'd be pretty cool to have the formula to make saran wrap. It'd be pretty cool to have the formula to make Coca-Cola too. But these things are protected. So tremendous due diligence done on the process of turning soybean oil into a plasticizer. But 18 months after the investment was made, there was an explosion at the factory. And it turned out that the chemist that turned the soybean oil into a plasticizer did it with something that we might call today a nuclear reactor. And that, unfortunately, was not fully disclosed in the process of buying and selling, notwithstanding third-party specialists of all kinds looking at the deal. So that's an example of bringing in all the resources that money can buy and still missing something very, very important. And I could give you half a dozen illustrations of where that has occurred with people that have all the money in the world to bring in the best people, and they miss something that's right in front of them. It might be an underfunded major medical plan. It might be an undisclosed element of an underfunded pension plan. It might be how income is recorded as earned versus accrued, and what are the risks of collecting it if it's not yet received. There's so many variables in terms of how we go through and manage due diligence. And thankfully, I personally haven't had any problems with buy side or sell side in due diligence, but it does happen.
So, what are some of the if you do enough, if you're in business enough, if you invest enough, you're going to have things go south or go wrong. And that's why, I advise people not like, when I say advise, it is just conversations with friends. And when I have conversations with friends and they're talking about investing into different deals, if they're new, they start putting in a significant amount of their liquid capital into a single deal, a single asset or asset class.
Yeah.
And I like to spread my investments, instead of making a $100 or $200 or $300 or $500,000 investment into a deal, I'd rather spread that out with multiple $50,000 or $100,000 investments in a lot of different deals and spreading that across different asset classes, because at some point things go wrong. How do you view things going wrong, deals going bad, and how do you deal with that mentally, and just, how do you really take learnings from that into your next deal?
I think we go back to where individuals and families are in their cycle. So if it's wealth accumulation, they're likely to take more risk. And most individuals who buy a business, form a business, invest in a business are all about that business, because they'll tend to follow their money into the deal. And that's their first business. And that's all the business that they're going to have. And they're going to do as much as they can to build it, grow it, maybe add on to it, invest vertically, maybe invest horizontally across the industry. And maybe
so when you say invest vertically versus horizontally, dive a little bit deeper into that for the audience that may not have a full understanding of that.
For let's just say investing in mobile homes, for example. So an investor may buy mobile home lots. That's ownership of real estate. But an investor may start actually trading and buying mobile homes. That's different. He may own them and rent them to tenants in his park. He may own and rent them to tenants in somebody else's park. He may decide that he wants to build a management company to collect rents, make sure taxes are paid, go through books and records, and own a management company that typically is going to charge 6, 7, 8, 9% of the gross rent receipts. So that's an example of vertical integration. Horizontal integration may be diversifying the portfolio into other types of companies. So maybe I want to build mobile homes. I might buy a metal fabrication plant and come up with a unique design for a particular type of mobile home in a price bracket. So now I'm investing horizontally and actually getting into manufacturing, which is outside of owning and operating a park. So vertical, horizontal, what have you.
I think even people in franchising, a lot of people double down on the brand that they have, and they're just going deeper and deeper and deeper into that. While others, you need to be thinking about, at what point do I diversify? Whether that's impacted by the economy, by COVID, and you mentioned it earlier, where am I geographically? When COVID hit, it did matter where you were in the country. Same brand, same franchisee, different states, had different outcomes. So, you look at all these different things, but there's things that will just happen that you can't control. They're completely out of your control. But what is in your control is to diversify, or to, instead of just going vertically and deeper into a certain brand, it may be time to start looking at something that is non-correlated to what you're currently doing.
Oh, yeah.
Any thoughts on that?
Well, there's hundreds of illustrations of private families that own multiple franchise organizations. They may own barbershops, hamburger restaurants, ice cream stores, and they've just figured out how to operate these points. And maybe they're clustered together in a common geographical area where they can keep an eye on them and manage them and essentially inspect what they expect, which is, I think, essential in running any business. Or if they broaden their organization, they may have, 50, 60, 70 of each, and maybe they have 5 different types of franchises. That's not uncommon at all.
So once you have a lot of money, you are not the operator, usually. So I've talked to some operators that have a lot of money and they're just still operating these businesses. But think family office, ultra high net worth family, and they're bringing somebody else in to run these types of organizations. What does it look like? What does that look like on the inside of a family that has money and they're in that wealth, whether it's accumulation or preservation, but they have that management that's taking care of everything for them? What's that family really focused on at that point? Like, what do they do day to day? What keeps them up at night? What do they focus on? What are their priorities?
Well, first of all, they have fun. Because they have private planes and they have private motor yachts and they own a lot of real estate for recreational and vacation purposes. Thankfully, the ones that I've worked for were engaged. They were not absent. Were they engaged all the time? No. They had other interests, whether it was family, friends, travel, what have you. I mean, what's the point of having all that money if you can't enjoy it? But the folks that I worked for, several different families, were all engaged, always available. And the beauty of running those kinds of businesses for someone like myself is I could get a quick answer. I didn't have to go to a board of directors. I didn't have to sit down with a whole bunch of shareholders. I didn't have to compel a lot of people that were not in tune and not in step with what was really going on. If I kept the families informed and posted as to what was going on, then there were no surprises. I should say there were almost no surprises. We had a business in aviation shortly after the investment was made where the CEO died unexpectedly within months of the investment. Now we have an airline that's leveraged with acquisition debt. The CEO is deceased, highly respected individual in the community and in the aviation industry. And I said to the family, look, we'll get the best airline people that there are, and we will right the ship and we will be just fine. And they said, you've worked for us for 10 or 12 years now. Maybe you should go over there and figure it out. Maybe we don't need more airline people. Maybe we need some finance people. So, I'm in the deep end of the swimming pool often in my career and finding out how to make things work. And that's a lot of what I've done.
So when you are, when you're thrown into something like that, and you look at these different companies, how do you view talent? Is it, do you want, one A player leading the company with some B players, or is it all A players, or is it a combination? Because it's hard to have all A players, like amazing C-level and director level talent. But how do you look at bringing in talent for an industry that you're not fully, you didn't grow up in?
That's a really good question, and I have some really interesting experiences where I could share with you a few illustrations. One, in the C-suites and even at the middle level, I would often use an industrial psychologist to do some independent third-party testing just to try and figure out what we were dealing with in terms of the candidate. And this was after we had pretty well decided to hire the candidate, but had not made the offer. And so it was, if you will, somewhat of a third-party validation that we were hiring somebody that we could work with, that would be a team player, that would provide leadership, make decisions, was honest, integrity was had to be substantial. And in many of these businesses, they were highly regulated: Department of Transportation, Comptroller of the Currency, FDIC. These are all highly regulated industries. So we have to do really thorough background work when we hire and recruit people. So I would say third-party validation is essential in the C-suite level. Also, my experience has been that while we go out and look for and recruit for talent, many times the talent is right inside the company. I can recall a bank once where the president gave us plenty of notice that he was retiring, and this particular bank was in a particular industry where talent wasn't always available because of the nature of the bank and the type of clients that it had. But we found an individual in the bank, after interviewing a lot of people and not finding the right one, who was well-educated, credentialed, entrepreneur in his own right, had formed several businesses, small businesses, sold them, decision maker, well-liked, really a solid guy. And he was right there in our ranks, and we had passed over him. We already started a recruiting process. So we hired him. He became the president of the bank. He later became president of 2 banks, and he became president of about a half a dozen banks. And we let him do hiring and recruiting. And he was excellent and superb.
Let's talk about that third-party evaluation, because you mentioned it twice now. You mentioned it here after your decision to hire, but the offer has not been given to a C-suite individual. You also mentioned it earlier when we were talking about due diligence and hiring a specialist to understand the things that you don't know. And a lot of times when a lot of these bigger mergers and acquisitions in franchising and outside of franchising, they hire firms to go do research. They will talk to franchisees. They will talk to customers. They will talk to industry experts. So they're not just evaluating the company. They are learning about the industry and different things. So just talk about some, third-party evaluation. Like, how much weight do you put on that? And why hire a third party to do some of these things? Then think about, you're talking to someone that says, I don't want to spend the money on a third-party evaluator because I don't have a $100 or $200 million acquisition that I'm dealing with, or I'm not spending $500,000 on a C-suite individual. But there probably still is areas where they should be looking at third parties to do some of the evaluations and due diligence.
Yeah. It may depend on whether the person we're talking about, the business person, is buying a business or selling a business. Let's just talk about buying a business. So typically, if a person is buying a business, they may rely on their own people and their own staff to help them make an analysis of the business that they're about to buy. So if they own a business, they have an accountant. It might be a third-party outside CPA firm, but they have that resource and trusted resources that they can bring in and look at the books and records of the company they're going to buy. If they don't have a business and this is their very first business, it's it's probably going to be challenging for somebody buying a business the very first time without a history or connection of resources. This probably is where mentorship would come into play. If someone's buying their first business and they've never bought a business before, maybe they've worked in a business, but they've been an employee, not an employer. They may be looking for a mentor or someone that can guide them in terms of what to look for and how to analyze that business. If it's their first business, they're probably not going to go out and hire an investment banker. It's just not probably in their wheelhouse. But they could through their bank, if they're using bank financing, find resources. The bank may refer them to a CPA firm that could come in and help them understand books, records, finances, and so forth. And of course, it's going to be essential, whether it's a buy side or a sell side, that they have legal counsel and legal representation. And we often advise our clients to engage counsel early so that they can establish a relationship with counsel. Counsel can size up what the needs and requirements are of the client, whether it's buy side or sell side, and then be prepared to give the advice along the way. And of course, the deal may not close, the deal may blow up, it may something might be found in due diligence that trips the deal. And I think a buyer always has to be prepared to renegotiate or back out of a deal. Though they may have their heart set on it, they already envision in their mind that they own this business, they don't own it yet, things will happen. And we've seen it happen all the time where there has to be a revisit on any number of issues. And lastly, I would say price isn't everything. Terms are important, and terms oftentimes are more important than the price itself.
That's good advice right there. That's really good advice. All right. As we kind of wrap things up, I'd love to hear more about the book, No Locked Doors, Master the Keys to Turn Problems into Possibilities.
This is my first book, and I wouldn't have written it but for a dear friend of mine who compelled me to do it. He had asked me to do it for years and years. He gave me a leather-bound journal and a very expensive pen, and he said, "I really think you should write your book." And I never got around to doing it. So this is someone I've known for about 17 years. We met in some unusual circumstances. I found in him just tremendous innate native abilities to absorb, and he personally wanted to grow. As it turned out, he was able to grow with interest in business. My interests are in business. So I began to mentor him in 2005, 2006. He decided that I had done so much for him, he would like me to mentor others, but there's only so many hours in a day to do that. So he said, "Would you write this book?" And I'm really more of a shower than a teller of things, but a book has to be about telling because it's words. So he engaged a company, which is a publishing company by the name of Scribe, not plugging Scribe here, but they did superb work for me. And all of a sudden I had a ghostwriter, I had a schedule, I had a calendar, I had appointments, and my story was about to be told, which is really about what it takes to find the inner strength and capabilities to meet challenges and conquer challenges. And that's why we call it No Locked Doors, ! It's an affirmative statement. There are no locked doors. And sometimes we have to look at a door that, we just can't seem to get unlocked. And we look at the light coming through the keyhole and the light coming under the door, and we just haven't got the key. Maybe we have to get on the other side of the door and look at the light coming in from the other side, see what's above it, what's around it. And then finally, because we can be persistent and focus and open to positive thoughts, we'll somehow or another manifest a way to open that door. Does it always happen? No, of course not. But I think people tend to walk away from too many doors that if they would walk through the door, they would find a greater, more fuller experience in their life. And when we conclude the book, at the end, we describe why the journey really becomes our destination. We're all focused on destination and achieving and goals and orientation, but it's really more about the journey, what we did, how we did it.
Greg, I can't wait to read it. I encourage the audience to get it because we've just scratched the surface with Greg. There are things that he knows that he can't talk about right now. There were situations that was involved with that are off limits, and the depth of knowledge and experience that Greg has is fascinating, and I have so much respect for him. And Cosm is the one that he mentored, and Cosm was the one that had one of the most popular episodes on this podcast. And we've had some amazing guests on, like Robert Kiyosaki and people like that. And Cosm's, I got a ton of feedback on it. And so I'm glad you decided to mentor Cosm. Any last bits of nuggets on mentoring before I let you go, Greg?
I just would say, as having been both a mentee and a mentor, it's an important relationship, and I think it's going to be essential for a lot of people to be successful, is to reach out and find somebody that will care enough to give some time for some good, solid guidance and someone that can be trusted.
Thanks for coming on, Greg.
Pleasure, Eric. Thank you.
Thanks for listening to the Franchise Secrets podcast. Links to everything can be found over at franchisesecrets.com. And if you want my help with anything from starting your own franchise to growing your current franchise business, please visit scalablefranchise.com.